There's so many different ways I can start this session, but I'm going to use a few things that Dan said to kind of get started. First is, Dan took my class 33 years ago, so I've been teaching at Stern now for almost 4 years. I taught it, my first year at NYU, was called Stern then, was 1986. So that's 38 years. There are people in my class whose parents went through my class. One of these days, I'm going to run into a grandparent, and that's when I know it's time to hang up. I can complain about getting old, but the alternative is so much worse. In fact, one of the reasons I wrote this book, Corporate Lifecycle, is it's really the least valuation-specific book that I've written. It's about, because we all fight aging. It's human nature. You get old, you want to be young again. And what do? You go to a plastic surgeon, you get surgery, you hire a physical trainer. And I noticed that businesses did exactly the same thing. They fought aging. And there's an ecosystem of people egging them on, right? Consultants and bankers. Let's face it, if companies acted their age, 90% of the work consultants and bankers do would disappear. What do bankers do? They go to companies and we can make you young again. Just do that acquisition. And just as with human beings, it never works. You do plastic surgery, gravity works its magic. 5 years later, you're back to where you were and you go back to spending money again. So it's part of the process. And the other thing that was mentioned is the Dean of Valuation thing. I was on CNBC this afternoon with Scott and Closing Bell. And the first time I've physically been in there because I usually do it on Zoom from San Diego. I'm looking at the ocean while I'm doing it. Glad I'm here. No, but today I was in the studio, and of course he introduces me as the Dean of it. It makes me cringe every time. So I have to tell you the story of how I ended up with this title. You think it's because they appreciated the work I do in valuation? Not at all. So about a decade ago, I was on CNBC, and the anchor had a real problem pronouncing my name. He tried for like 3 minutes before the show. Tell me your name again. And after about 3 minutes, I give up. I'm just going to call you Dean. And it's stuck ever since. So if you think Dean of Valuation is some suggestion that I know a great deal about valuation, it's just an indication that I have a last name that is tough to pronounce for some people. So with that out of the way, for today's session, when I was asked what am I going to talk about, I'll tell you something. I'm not an AI expert. In fact, I'm an expert in very little. I'm a dabbler. That's why I describe myself. My interests go from week to week. So this week it might be AI, next week it might be baseball, the week after that it might be entertainment. And I'm going to talk about the advantages you get when you skim on the surface rather than get deep and specialized in one area. I know very little about AI. So much of what I'm going to say is going to come from the perspective of somebody that I think you should think of as an AI novice. I've never seen an NVIDIA chip physically. Only time I saw it, actually the first time was when Jensen Huang held it up, I think in one of the shows. He said, that's what it looks like. That's what a $3 trillion company designs. Not makes, right? Remember, NVIDIA doesn't make a single chip, it designs. That's what $3 trillion looks like. So what you're going to hear from me is going to probably cut against what an expert would say about AI. But before I get started, I have a question. What is AI? We act like AI was born on November 30th of 2022. You know what's special about the day? What happened on November 30th of 2022? So ChatGPT showed up. And all of a sudden, talk of AI filled the air. Obviously, it wasn't born on that day. It's something that's been around for 15, 20 years. I see products that I saw 8 years ago that now have an AI in their name. So first, let's nail down what AI is. It's a culmination of two forces that have been building up for decades. One is increased computing power. As I was walking here, I actually took the walk because I wanted to, it's a nice day, I was walking, so I might as well walk the 45 blocks. As I was walking here, I was checking my iPhone, and as I checked my iPhone, I thought about the computing power in my phone. And if you come to my office, I actually have my first Mac 128K. 1982, it's up there. I don't use it anymore. It's a working Mac 128K. For those of you who've never seen it, it didn't have a hard drive. It came with a floppy disk. You put the floppy disk in, you wrote a document, and then here came the dangerous moment. You had to inject the floppy disk with the writing program and put in a new floppy disk and hope and pray that in the meantime, the document didn't disappear. My smartphone has 500 times the power of what we call a computer in the early 80s. So computing power has been building up. It's coming in smaller and smaller packages. The other big development of the last few decades is the building up of data. Not just financial data, but personal data. In the hands of companies. And before you get too indignant about it, who gave them that personal data? You and I did. In return for what? Convenience. We let, I checked, as I was checking my phone, just to see how many of my apps were tracking my location. There are 17 apps that were tracking my location, all of which I gave permission to. Some of which I have to give permission to because without them I can't use my Google Maps. Some of which I gave permission to because I need to find a restaurant close by. We're giving data, and that data is building up in immense databases. Computing power plus data is really what AI is. It's that combination. Now, this again is something that's not new. You remember the early 1990s, IBM came up with this, I think they called it Big Blue, this machine program that could play chess. And it very quickly became better than the very best chess grandmasters in the world. And there's a simple reason. You feed a computer every chess game that's ever been played in history. It remembers everything. So when you make a move, there are no surprises. In 1935, I saw that move, and I saw what people did to counter the move. So I wanted to think of chess as the perfect replicable machine learning product. So machine learning has been around a lot. So what does AI do that machine learning doesn't? AI is almost sentient. It's kind of a scary word. You've ever seen 2001 and HAL? Where it becomes almost human. AI is sentient in the sense that it takes data, which is incomplete, and it uses what it's learned from observing human reactions to incomplete data to fill the gap. Sometimes it does it well, sometimes it fantasizes. There's always this problem. You've seen this in ChatGPT, where it goes off into fantasy lands. But it's here. There's no point complaining about it. So I wanted to talk. I gave two choices for this session. I said, I can talk about AI and businesses. Now we can talk about the business effect. And I'm willing to talk about how is AI going to play out in businesses. I have a valuation of NVIDIA in there, which, given that the big day is tomorrow, a lot of people say what's going to happen in the earnings report. And I'm willing to give you what my thoughts are about NVIDIA. You've probably seen them already if you watch CNBC or read my blog post. Or I said, I could talk about how AI can affect you and what you do. And especially if you're in your 30s, I'm too old, I don't care if AI replaces me, but many of you should care more because you're at an age where if you're doing something where AI can do it, this isn't your tool. People think of the AI as a neat little tool for me. It's like riding in the back of a tiger. No. You're riding in the back of the tiger, the next thing you know, you're inside the tiger. So if there's a cautionary note here, you can take it home and think about what to do. But I think it's a message that I think is worth hearing. And along the way, we'll talk about essentially, because if you talk about how AI affects you, you're also talking about the business prospects for AI. So let me get the process started. I put too much stuff on my slides, I know it. I should change it one of these days, so don't try to read the slide. So I teach all of my classes in the spring. I have this very neat arrangement with NYU, neat in the sense I work like 4 months a year, 3.5 months, only on Mondays and Wednesdays. And because I work so hard, I get this every 7th year off, the sabbatical. Don't let any professor tell you they work hard. This is about as cushy a life as you can get. I'm not going to change it. I'm not disrupting myself and saying, how come somebody else does it? So I teach all my classes in the spring. I teach 3 classes. I'm kind of locked in now. In fact, the class I taught Dan is still the same, the valuation class. Yeah. So I started teaching valuation in 1986. First valuation class taught at any school anywhere, but it was a full semester class. I know Ben Grant taught a security analysis class in the 50s. There was a little bit of this and a little bit of that. And really, it wasn't about value companies all the way through. So I teach 2 valuation classes. One to the MBAs, most of whom are second-year MBAs. And teaching second-year MBAs in the spring semester is a bit of a problem because you have this problem that I call premature graduation, which means around March you're already graduated and mentally I've got to pull you back and say, you're not done yet. And I also teach exactly the same class, every single slide to the undergraduates. Ask me the question.
Why?
Why is it? Because I like both groups. But what's the difference, right? I mean, is delivering the same material, is it easier in one class? It's different. The undergraduates are much better at the mechanical stuff. Why? Because they still remember the order of operations. Right? And MBAs now in museum directors, they haven't seen a number in 15 years. The order of operations is some distant memory from 5th grade. So their struggles are not with finance or valuation, it's with which comes first, bracket or multiplication, right? So with the undergraduates, they get the mechanical stuff, but they don't have any perspective. They've never been in the business, so inventory to them is a line item in a spreadsheet. Right? With the MBAs, they have perspective, but their mechanics are really bad. So it's interesting, you can deliver the same lecture to 2 groups and actually get 2 very different sets of reaction. When people ask me, are we both teaching the same class over and over again? It's different to each group and each time you do it. In fact, tomorrow and on Friday and Saturday this week, I'm going to be teaching my valuation class in compressed form in Portugal to a group of Portuguese business people. It'll be a very different experience because they come from a different background. Portugal until 30 years ago was an emerging market. They made some transitions. It's going to be fun and interesting because it's going to be different. So I'm teaching my class, 11th week of my class. My good friend Vasant, who teaches at Stern, he teaches a machine learning class. Vasant actually got his PhD from Carnegie Mellon, and his PhD actually included the words AI in it in the 1990s. So he was AI before AI was even something that people thought about. So he calls me and says, Aswath, we built a Damodaran bot. I said, a what? He said, a Damodaran bot. I said, what the heck is a Damodaran bot? He said, we created an AI entity and we fed it every single thing you've done. And one of the things that makes me easy to access is everything I do in the public domain. So when Dan mentioned that this class would not be recorded, that's unusual. I don't remember the last time I wasn't recorded where it didn't end up somewhere before the class even ended. Everything, every class I teach, every lecture is recorded, it's on YouTube. Every blog post I do, every evaluation I do. So my entire life is out there. He said, we fed it everything you've ever done. It's read every blog post, it's read every one of your books, it's looked at every evaluation you've done. He looked at every YouTube video, and I said, now what? He said, it's ready. I said, ready to do what? He said, ready to value companies. He said, we'd like 20 of your students, and we can volunteer if they want to do it. Because every person in my class is to pick a company to value. They can pick whichever company they want. He said, we'd like to run a competition where they value the company and the bot values the company as well, because we want to see how well the bot can do. So I said, sure. And I thought about the end outcome, and I was terrified of either end outcome. There are the 2 possible end outcomes. One is, it beats my students in every single, in which case I'm asking, what am I doing? Basically, the bot can, you can learn from the online stuff. The other is it does terribly, in which case, my teaching is not working. The whole reason I put this stuff on is to teach people how to value companies. So it's still early, it's been showing me a few valuations. I did an evaluation with BYD. Familiar with BYD, the Chinese electric car company. And if I were giving a grade, I would say B plus. It does the mechanical stuff really well. That's kind of scary if you think about it. Because it is a machine. It's doing this based on what's out there, the data is out there, the knowledge is out there. So I started thinking about the bot. And the fact that every one of you, whether you know it or not, has a bot looking over your shoulder right now. It might not have your name on it, and you might not have had a call, but you can assume there's a bot. So as I do this, I want to think about the bot looking over your shoulder and asking, what can I do that the bot can't do? Okay. So let's frame it that way, because that's going to give us a sense of what can we do to stay ahead of that bot. We'll talk about what if this never happens. Because let's face it, AI might never make it to that point. We'll talk about why it still makes sense to act like there's a bot looking over your shoulder and doing something that makes you. So let's start the process by thinking about, what this threat comes from. It comes from the fact that you have all this computing power, all this data, and now you can feed it into a bot or an AI entity that can now try to replicate what you do. So let's start with the kinds of things that AI is going to be able to do really well. First, if what you do is mechanical, rule-based, a machine is going to be better than you are, right? When I write my posts, sometimes I put in a link that doesn't work because I'm being sloppy, I get tired, and I misspell words. I actually leave them as such now. I claim it's because I want to show people what didn't write it. It's because I'm sloppy. Machines are not sloppy. They don't get tired. At 11:30 at night, they don't say, I want to go have dinner. Let's rush through these last 3 inputs. If what you do is mechanical, and as I said, this session is not about me. I want you to look inward at what you do every day. If you're doing the same thing every day, the same process, the same sequence, machine can do that better than you. If what you do is rule-based, what do I need to do? There are entire professions that should be looking over the shoulder, right? And how many of you work in appraisal and accounting firms? Fair value accounting. Fair value accounting is designed by accountants. What do accountants do? They write rules. Why do they write rules? Because they don't want you to make subjective judgments. You don't want, I see why, right? You don't want to creative accountants. Creative accountants get you in jail. You don't want that to happen. But because fair value accounting is so incredibly rule-based, it's going to be set for a machine. In fact, I'm going to talk about why it hasn't already happened, because you don't need NVIDIA chips and immensely powerful computers to do this because it's very rule-based. Now, if I get a chance, I want to talk about that. That was the DeepSeek opening, saying, hey, you don't need all this stuff for some of the rule-based. So if it's rule-based and mechanical, it's easier to replicate than if it's intuitive. Okay, so if you're doing something where there is an intuitive component, hold on to the intuitive component. In my classes, when I value companies, I have trouble with engineers and numbers-oriented people who come into my class. Much more than history majors. One of the things that they struggle with is when I have to make an assumption about the future, which is pretty much everything in valuation, their critique is, but that is subjective. As if that's, for them what subjective is a terrible word. I said, be glad it's subjective, because everything we're objective, you don't need me, you don't need you, machine can do it. So is it mechanical or rule-based? Intuitive, adaptable models are more difficult, not impossible, but more difficult to replicate. Rule-based versus principle-based. I dump on accountants all the time, so you're an accountant, don't take it personally, or do I really don't care. One of the things I tell, one of my pushbacks against fair value accounting is I call it an oxymoron. You can either do accounting or you can do valuation. You try to do both, you're going to fall right down the middle, which is what accounting is done. Right? And one of the problems with when you look at accounting is it's very rule-based. Everything is driven by a rule. Valuation is principle-based. You've got to give people the room to make discretionary choices. If you're truly doing valuation, it's much more difficult to replicate what you do than if you're an accountant following 685 rules to get to that same place. Third, this notion of subjective versus objective. We make subjective into a bad word. But it is in fact the reason you can stay ahead of the machine is because you got to make subjective judgments. Can you value NVIDIA without making a judgment about how big the AI chip market will be? I don't see how. How can you even value the company if you can't tell me whether the market's going to be 300 billion? And to make that judgment, you got to make a judgment of how big the AI market will be. Because remember, to invest in all this architecture, you got to be able to sell a lot of stuff. See, but that's going to be subjective. Yes, it is. Why is that a surprise? If it were objective, we could all value NVIDIA. But the truth is subjective is your competitive advantage, your moat. Is you make estimates, you make judgments. Again, I'm not saying AI can't do it, but you're in a position to make a judgment. That's something you should hold on to.
Can I ask you a question, Professor?
Go ahead.
From your experience of 40 years or so, what percentage of finance is objective as versus subjective?
I tell you, 95% of banking doesn't deserve to exist. Much of consulting is cookbook consulting, right? Where you essentially take the cookbook and you apply it. So I know it sounds harsh, but this is the process. We talk about why you still have bankers and consultants and appraisers even though you don't need them. Now, about 12 years ago, friend of mine, Anand Sundar, who teaches at Dartmouth and I.
They can raise money for NVIDIA.
No, they can. I mean, they're dealing. You can talk about why they exist. I mean, but it's not for value added from things you're doing, not in much of what you do. If you work in banking, look around you and say, what does that guy do, or what does that person do? And you very quickly, as you dig deeper, you say, I'm not sure what value added there is from doing that. So as you look at much of what we've developed as process in finance, it's become mechanical, it's become rule-based, and we'll talk about how technology is actually making us worse at things. You know, I wrote a book called Narrative and Numbers, and I'll talk a little bit about why I wrote that. It's because when I look at valuations now, what I see is financial modeling. You're an Excel ninja. Spreadsheets that have 500 line items. People have lost sight of what the value of a business is because they're so busy with financial models. So all those tools that we've used have essentially set us up to be replaced by machines. So if you were, if you were creating a conspiracy theory, you could argue that this whole thing has been a conspiracy all along to get you to replace yourself. Congratulations, you've done a really good job, right? Because that's where we've been leading. And you could argue that business schools feed into the process, right? Because we feed you rule-based ways of thinking about things because that's what business schools are supposed to do. And in the process, we've also created very mechanical decision-making, where you follow flow charts and you come up with pretty much the same decision every time you're faced with choices. And finally, you talk about valuation in many contexts. Let's face it, in many cases, people decide what the value should be first, and they do a valuation to back them up. I call these kabuki DCFs. Why kabuki? Because you want to come up with $3 billion at the end, so what do? You make it look like you're going through a valuation. Look at the cash flow, look at the growth rate, look at the discount. While I'm distracted, $3 billion comes out of the other side. Why? Because you have a job to do. You have deals to get done. You have other incentives. It's not because you're a bad person. It's because your job rests on getting deals done. I've always wondered why we do valuation in M&A. You know what value we're talking companies? It's whatever you've chosen to pay for it plus $10. You're going to get there, right? Because if you come in and say the value is less than what you're paying, you have a problem and I have a problem. You have a problem because I'm going to switch to another investment banker who will give me the answer I want. I have a problem because I now have to then explain to a court. So this is essentially such a biased process that the end game is determined. Now I would argue that a lot of processes, the end game is determined and you do a kabuki dance to make it look like you went through this analytical and decision-driven process. If the end game is determined, you know what? AI is going to be a lot better at doing this and a lot faster. than hiring 12 bankers to spend 2 weeks playing with growth rates and discount rates to come up with the answer you want. AI can do this in 2 seconds. And they'll have no conscience. These 12 bankers go back and beat themselves up saying, I played with the numbers. AI doesn't care. So if your processes are biased, again, you're begging to be replaced. Because the whole process then is to feed an answer you've already touched. So feed into AI. Target company's values, whatever we paid plus $10. Now give me a valuation that the Delaware courts will accept as looking like a valuation. It'll do an incredibly good job without breaking any rules along the way. So with that lead in, let's talk about what you can do to respond to AI. And I can't tell you what you need to do, but I can tell you what I think about doing where I said this. And maybe I'm delusional, maybe these things won't hold up. But these are the things that I think about as what I can do that AI cannot do as well. So let's start with the first one. We spent the last century encouraging people to become specialists, right? It sounds very good. I have 4 kids have all gone through school and college, but starting in about 7th or 8th grade, they were already slotted. You're good at math, you're good at science, you're good with history, and you're encouraged to specialize because that's how you get into a better school and then you take a degree. And we have a world of specialists. You notice this in medical, in every discipline, right? Healthcare. I mean, it's so difficult to find a general practitioner anymore because they don't make enough money. You've got to go to specialists. And every specialist is really good at what part of the body they look at, but they're completely oblivious that there's the rest of you attached to your knee. Right? So they can tell you the most amazing things you can do with your knee. The fact that your heart will fail right after they do it's not out of. We've created a world of specialists. There are fewer and fewer people who are comfortable outside their domain. I mean, when I started, I've never worked in investment bank, and thank God for that, but there were times when I started, and I walked into investment bank, and you could talk to bankers, you could talk about culture and drama and history and bond markets and stock markets, and they could talk. I mean, today, I don't want to kind of put everybody in the same bucket. You talk to an investment banker who's done the same thing for 30 years, they can tell you everything you need to know about mortgage-backed securities. But that's it. Their entire world is up because that's how they built their reputation. And I think by doing that, you can see why we push people to do it because that's how you're supposed to create a moat. You know more about mortgage-backed securities than anybody else does. I think we've created a problem because AI will know far more about mortgage-backed securities than you can because it can take all accumulated knowledge at this point in time that's on any computer anywhere in the world and take it as its own. So, to kind of bring home when I started thinking about this, about 12, 13 years ago, I was in Florence with a family for a summer vacation, and you've been to Florence, you know what that building is, right? It's the Duomo, the most famous building, second largest freestanding dome in the world at the time it was built. You know what the largest was? The Pantheon in Rome, which was built 1,500 years before, but people had completely forgotten because the barbarians had come into in the middle and all that knowledge had been gone. So it was the middle of the day, it was hot, and everybody took a gelato break. Always popular in Italy in the middle of summer. The rest of the family wanted to go. I was sitting there on the side step, looking at the Duomo, reading a little brochure about how the Duomo was built. And it was designed by a guy called Brunelleschi. It's an amazing engineering marvel, right? You know, Brunelleschi started off as he was an artist. In fact, one of the doors on it was one of the doors that he worked on art on the doors. He knew nothing about engineering, nothing about construction. And he taught himself enough of each of those disciplines. He actually went to Rome, lay under the Pantheon dome, looked at the dome to see how they're being put up, trying to figure out how they're done. And he managed to put it together. It's a classic Renaissance man, right? You use science. Those Renaissance men or women are no longer amongst us because in our zeal to specialize, we've essentially pushed those generalists out of it. There's a very good book on forecasting or compares foxes to hedgehogs. That's the analogy I know. Phil Tetlock, I think, is the author, where essentially compares the forecasts that come from specialists, who know everything, as opposed to forecasts that come from generalists. And it's an amazing book with the basic conclusion is the forecast that you get from generalists who know a little bit about everything is far better than the forecast you get from specialists who are immersed in it. You know, the people I least trust on AI is the people who are immersed in AI. They have zero. They think the whole world revolves around AI. So if you're a specialist, I'm not saying you need to do anything different, but hang out with other people. So if you're in equities, hang out with the bond guys for lunch, right? Talk to the homeless guy on your way home. Who knows what you might learn along the way? You know, kind of broaden your horizons, because we very quickly get into smaller and smaller spaces where we talk to people who think exactly like us. Second, now when I started teaching valuation, I taught it like I was supposed to. It's all about the numbers and the ratios and the equations. And about 6 years into teaching this class, I had a crisis of faith. Strange word to use in the context of valuation. I don't value companies for other people. I value them for myself. So the only reason I value companies is because I want to be able to act on my valuation. If I find something to be cheap, I need to be able to buy it. And you know where the crisis of faith came? About 6 years into teaching this class, I realized I could put a number on pretty much any company. I knew the techniques of valuation, but I couldn't pull the trigger because I knew how easily I could move that growth rate from 15 to 25% and make the number whatever I wanted. And I had two choices. I could keep teaching valuation as a person without faith, which a lot of people do, right? It teaches an abstraction. I couldn't take that. I said, I either have to get faith or I have to let go. And I started thinking about what I was missing, what I needed. And what I realized I needed was my numbers had nothing holding them together. That's when I started thinking about storytelling. And that doesn't come naturally to me. I'm a natural number cruncher. I want to open a spreadsheet and enter numbers. I had to teach myself storytelling. So if you ever see if you go through my book, Narrative Numbers, it's about the process that I use to force myself to tell stories. So when I start my valuation class, I ask the class. There are about 320 people in my MBA class, about 350 in my undergraduate class. It's an amphitheater. I ask them how they would classify themselves. Are you more naturally a storyteller or a number cruncher? So let me throw that question. If you were to classify yourself as a person, would you more naturally think of yourself as a storyteller or a number cruncher? So think about it for a moment, because I'm going to ask for a show of hands. Okay. How many of you are more naturally number crunchers? And you probably knew very early in your life, right? You liked the algebra class, you hated the history class. So essentially, how many of you are more naturally storytellers? And that too played out. And when I ask this in my class, the number crunchers think they have the advantage. In fact, their reaction is, what the heck are you guys doing in this class? You're a history major. Go take the strategy class. And that's when I have to introduce them to what I think is a very disquieting reality. A good valuation is never numbers in a spreadsheet. You have numbers in a spreadsheet. It's not a valuation, it's just numbers in a spreadsheet. A good valuation can't just be a big story. There are storytelling classes in Silicon Valley for founders. They tell fairy tales, amazing stories. Terrible story. We found a blood test, the 2 drops of your blood had a chain for blood testing. This is amazing $9 billion price. A good valuation is a bridge between stories and numbers. And I want to be explicit about what I mean by that. When you see a valuation of a company, take any of my valuations, when you look at a number, let's say Tesla's revenues, $500 billion in year 10, and you ask me, why did you have, why the revenue is $500 billion in year 10? Here's the answer you shouldn't get. It's because I used a 50% growth rate for the next 5 years and 10%. That tells you absolutely nothing. I need to tell you my story for Tesla as a business. And here's the challenge. What's the largest automobile company in the world right now? 300 billion in revenues, right? I am making Tesla 67% larger than the biggest automobile company. And remember, Toyota sells 9 million, 10 million cars a year. That's already a big story. I made it even bigger. There's almost zero chance you can get there with just cars. So I've got to come in and fill the difference. What else can Tesla do that will get them to 500 billion? Maybe the automated driving story. Maybe it can be the energy story. But the onus is on me when I throw a number out there to tell you a story that justifies the number. And what makes it even trickier is the only way you can get even remotely close to the value that Tesla's at is to combine the 500 billion in revenues with 15% operating margins. Now, how many automobile companies make 15% operating margin consistently? Luxury automobiles. Maybe Ferrari does it, but it sells 8,000 cars a year, not 8 million cars a year. And there again, the question is, how come 15%? And I have to spin a story. The advantage of stories is that I can't hide behind a number, because then you can say that's bullshit. And that is good because you're being challenged on the core part of your story. So one of the reasons I talked about valuation in my class is to essentially get people to tell me the story. So when they turn in a DCF, I take their numbers and I say, this is the story I'm seeing in your valuation. Do you believe this about your company? There was a valuation last couple of years ago that I got from Netflix, which gave Netflix $660 billion in revenue. So I called the guy in and I said, do you have Netflix? He said, yes. I said, how much do you pay per year? He said, about $100. This was a few years ago. I said, how many subscribers would Netflix need to have? That's $660 billion in revenues. He pulled out his calculator and I said, you don't need a calculator. You got $100 a year, $660 billion. You need about 6.6 billion subscribers. He said, I don't see where this is going. Hang in here for a moment. I have a couple of other questions. How many people are there on the face of the earth? The only way you can get to the stories of every man, woman, child, and pet had their own Netflix account they were not allowed to share. He said, don't be absurd. I said, you're the one telling the story. I'm not the one. Sometimes taking the numbers. So this afternoon on CNBC, I was asked, do you think NVIDIA is an amazing company? I said, it's one of the most amazing companies I've seen. But to get to a $3 trillion market cap, you need about $600 billion in revenues with margins at levels that they have nosebleed margins. Their gross margins are 80%. Essentially, they make TSMC, make their chips. They mark them up 80% and sell them to Meta and Microsoft. See, how do they get away with it? Because they're the only game in town right now. You assume this forever. You're telling me a story about nobody else is going to enter the business. Meta and Microsoft are not going to bring these chips in-house because you're paying 80% markup. At some point in time, you're going to be tempted to do it. That TSMC will keep making the chips and not demand a higher slice. If you can tell me that story and feel comfortable about that story, all the more power to you. But there are cracks already in the story you've got to deal with. And the advantage of telling stories, it forces you to think about the weakest next. So if you are in valuation and you have all the techniques nailed down and you're good with the numbers, work on your storytelling. It'll be hard work. The first time you try to tell a story for Palantir, don't pick Palantir as your first story. Make that your very last story. Because how do you tell a story about a company? You don't know what it makes, so you're afraid to ask because you might end up in Guantanamo Bay. But pick a story like McDonald's or Target or Deutsche Bank. You want a horror story. Right? And play it out. You get better as you work at it. 30 years after I started to tell stories for companies, I'm better at it now than I was. I'm still a natural number cruncher, but create your own process for bringing stories in numbers. Third thing, and this is something that I struggle with, with my kids, I struggle with my students, is when you have a question now, be honest, when you have a question to which you want the answer, any question, it's a natural instinct. How tall is that building? Pull up Google, do a Google search, 757 3rd Avenue. How tall is it? I guarantee you, it'll have a number for you. And for things like that, it's perfectly reasonable. Who wants to actually get a measuring tape and measure how high a building is? You have the data in your hands. But if you're valuing a company and they say, what tax rate should I use to come up with my after-tax operating income? Go on Google search, what tax rate should you use? There will be answers there. And even if the answer is right and you use it, you've essentially missed an opportunity. Why? Because there is a reason why we use a tax rate that we do in valuation. And if you sat down and think about what you're trying to do and trying to come up with cash flows, you could get to that reason. It'll take you a lot longer than looking on Google search. But you're exercising a muscle. It's your reasoning muscle. I am afraid we're losing that muscle. I'm afraid that we're looking up things so much that we've stopped reasoning our way to an answer. I drive my kids crazy because they ask me a question and I try to make up an answer based on reason. He said, Dad, you're making stuff up. I'm going to check on Google search. I might be wrong 20% of the time. Maybe I'm understating how wrong I am. But I need to do that because if I don't do that, that muscle, evolution is a beast. If you don't use something, you will lose it. I can't read a physical map anymore. I don't know how many of you can. But the GPS thing put an end to it, right? I've used GPS for long enough. It says go. And if my phone fails in the middle of a city, I am completely and totally done. I don't know right, left. I have no idea what to do anymore. There is, I think, something we need to work on. And it is work because it's so easy to look up answers. Next time you have a question, don't email me. Think through it first and then email me. I'll be glad to answer the question of what tax rate to use. So in an interview I did in teaching, I call this the Google curse, which is increasingly my students don't want to reason their way, they want the answer. And much of my class is about taking them through the reasoning process rather than giving them an answer. It's torturous for them. Just give me the answer. But I think we need to work on it. So that's, I think, again, something we're losing as we get access to technology and data. And finally, remember the old saying about an idle mind being a devil's workshop? That might be true sometimes. But I think, in a sense, what, imagine, Isaac Newton was under that apple tree. 300 years ago, it might be a story made up, but let's say the story is true. And he had a smartphone in his hand, and an apple had fallen on his head. Probably been pissed off because he had so many things to read on Facebook. You have the law of gravity, right? Archimedes sitting in his bathtub, checking out what's happening on the internet, would not have had time to think about the displacement effect and run out of the bathtub naked and say, Eureka, Eureka. And discover. If you think about great discoveries in humankind, they're often from accidentally connecting. I mean, who connects an apple falling from a tree to the laws of gravity? Right? It's almost magical if you think about it. But it happens because you have nothing else to do. When was the last time I remember 30 years ago, I'm old enough to remember standing in a bank line. Because you had to get to the teller to ask something. You had nothing to do while you stood in line. Today, if you go to an airport and you're waiting for a flight, you're filling every minute of your time with stuff that you think is important. You don't have time to wander. And just to give you an example of, two personal examples on how a wandering mind, I have a wandering mind. When I take my dog for a walk, in San Diego, first you're going to get high on your walk because there will be smoking around you. Your dog gets high too, so you come back both very much happier than you left. I don't take my smartphone with this. Now I'll give you a couple of examples of how and I do. So a few years ago, when I was still in San Diego, I'm still in New Jersey. This might have been one of the things that triggered my move to San Diego. It snowed and there's a feet of snow outside, and of course I don't have a snowmobile or a snow machine. I went out with a shovel and I'm shoveling 3 hours, and I come back. While I'm shoveling, now everybody up and down the block is doing exactly what I'm doing. Every adult is shoveling. They're all pissed off. You can see this is not what they want to do. The kids are all building snowmen. And I'm looking at this, that this is like a perfect way to think about value investing and growth investing. Value investors are like those adults shoveling the driveway. Everything is about burdens and all. Growth investors are like those kids. So if you're asking which one's happier, the kids building the snowman are probably happier. So I wrote a piece, it's still on my blog called, Snowman Shovel. So you get a chance to read it because I finished that while I was shoveling. I had nothing else to do, and this blog post is running through my head. And I came back and said, you know what, might as well dump it out there. The second happened more recently, in the start of 2024. I was checking my email first thing in the morning. And I have an email from somebody in Iceland who reads my books and uses my stuff. And he says, I have a valuation problem. I hope you can give me a solution. He said, I'm valuing a business called the Blue Lagoon. It's a legendary spa in Iceland. Been around a long time, great earnings, great cash flows. But there's a problem. There's a volcano that's erupted, and the lava is flowing in the general direction of the Blue Lagoon. And I'm looking through the books on how to bring in a lava effect into valuation, and I'm finding nothing. You have any ideas? I didn't have any right then. My dog needed to go for a walk, so we go for a walk without my smartphone. And while I'm thinking about what to respond to this guy's question, something else pops into my mind. As I said, I dabble, so the second thing that pops is this company called 23andMe. What is the company? It's in saliva, they give you your DNA, and about a year and a half ago, they had a catastrophic event. You know what the catastrophic event was? Somebody hacked into their computer, got the data on all 6.5 million to 7 million customers. Essentially killed the company. Catastrophic event. So what's that got to do with lava? Catastrophic event, catastrophic event. And then while I'm thinking about this, I then start thinking about fossil fuel companies. See, what's fossil fuel got to do with this? If climate change is what COP 42, 43, 44, 35, whatever it is, Baku and Dubai, already the hypocrisy of the movement comes through, where they put it, is right, then we're heading towards a catastrophe. And if that is true, then fossil fuel companies should go away, right? But that's not happening. In fact, you look at ExxonMobil or oil and gas, they're actually trading as if there's no catastrophe. And what's going on? And then while I'm thinking of all of this and pointing to other people, I remember that I live 2 blocks from the ocean, Pacific Ocean in San Diego, on one of the biggest earthquake faults in California. And I remember what I paid for the house. And what was I thinking? A hurricane, in this case, a tsunami or an earthquake, there goes my house. And I paid for it anyway. And while I was still on this walk, it's a long walk, my dog takes forever, I started thinking about the Mad Max movies. You see the Mad Max movies? Dystopian. And I think about how often in those movies, the characters talk about what's in their portfolio. Check out the movies, right? No, not once, right? Why? Because if survival is what you worry about, who cares what your stocks are doing? Essentially, what I came to the conclusion while I was in the walk is as human beings, when we have catastrophes, we set them to the side because in a catastrophe, your portfolio doesn't matter. So real estate in Manhattan might be underwater if in fact the oceans are rising, but you're still paying $1 billion to the building because in your mind you compartmentalize. If that happens, I am gone anyway. What does it matter that I overpaid for a building at that stage? I'm convinced that in investing and business, we set catastrophes to the side. We don't deal with them. Because if every morning I woke up and thought about earthquakes and tsunamis in San Diego, I'd go crazy. All of this on a 45-minute walk because I didn't have my smartphone. So you get a sense, there is this thing called it that I wrote on catastrophes, essentially coming out of that. So not every walk I do is productive, but the more time I let my mind wander, the more I have a chance of coming up with those, connecting unconnected things. That's what we have as human beings. And in many ways, as I said, we seem to be disarming on all of these dimensions because of technology. We look up answers, so there goes the reasoning muscle. We have time filled up by checking out our phones, there goes the free time. is almost, and that's why I said if you're conspiracy minded, you could also paint a picture of technology companies preparing ourselves for our own replacement. So if you're prepping for your whatever your job is, think about what you do and think about what you can do to make yourself do. And if you think about defenses, there are 3 ways you can protect yourself against the war. First is, and before I do that though, as you listen to all of these, maybe you're overdoing it, maybe AI will not be an issue. Maybe I'm overdoing it, but you heard of Pascal's wager? Pascal 200 years ago, the French mathematician who decided to mathematically prove that it's better to believe in God than not believe in God. So he used the thing and he said, if you believe in God and God exists, so think of a matrix where you believe in God, and you don't believe in God. God actually exists and God doesn't. He said, if you believe in God and God exists, you go to heaven. If you don't believe in God and God exists, then you go to hell. That alone, that trade-off alone, we say, you know what? It's better to believe in God than not believe in God, because the net effect of not believing in God is negative. I would argue that a similar paradox, a similar trade-off applies. Maybe AI will never become a threat, but how can it harm you to do the things we talked about? Because everything I talked about is basically working on your humanity, right? In a sense, each year we're losing a little bit of that because of technology, and maybe that's something we need to reclaim. So you think about protecting yourself, there are ways in which you can. So, if there's always a strategy of, for me, the reason I'm so exposed is everything I do is out there. And I said, look, what I do is so secretive that AI will never find out what I do. I know what you do. But no. And in fact, there are professions that shroud themselves in secrecy, hoping that nobody knows what they do or how little they do. The only problem is, AI doesn't need to see what you do. If it sees what you churn out as output, it can reverse engineer what you do. So secrecy is going to work only so long before it stops working. The second is you can get the establishment to protect it. Why do we need appraisers? I talk to private company appraisers and I look at what they do and say, why am I paying you guys? You know why I need to? Because regulators and courts will not accept an automated valuation. So even if AI does a better job in valuing companies than an individual will, I have to pay you. Otherwise, it won't get accepted. So there's system protection you can go after, and maybe that will protect your job. And the third, of course, is, and I think this is something that I would work on, is build your moat. What that moat is will be different for you than for me, because I think that acting as if it's not there, being in denial, is not going to make you better prepared. So that's all I wanted to say. So I would just open up the questions. It can be about AI, it can be about, as I said, I'm a dabbler. You can talk about corporate finance, valuation, investing, Tesla, don't ask me about Tesla, NVIDIA. So whatever it is.
So we have a couple of mics in the room, so just raise your hand if you have questions and we'll come to you.
You don't even need a mic. I'll repeat the question. Don't worry about it, because otherwise it takes a long.
So you mentioned that your bot was got a B+.
Yeah.
How many people are in your class typically are above a B+? What does that do to society when, no matter what barriers you sort of put in, it's only a small slice that's going to get saved?
Varun asked the question of, I said I'd give the bot a B or a B+. What did the bot not do? It got all the mechanical stuff right, didn't do that creative leap, right? So, which you talked about. So it did value NVIDIA, it can come up with the numbers based on them. And about 20% of my class ended up with more than B+, maybe 25%. So the bottom line is 75% of my class, a machine can do what they do. And that's not a bad thing for them. Basically, it means they should try something else. Maybe there's someplace else. But I think that it is scary. And that's why when people talk about AI as this neat little tool, my point is be careful. It's not that benign. Because we can do what you do. For the moment, you might still think of it as a tool, but the person above you, the company that hires you, at some point is going to say, you know what, we might need some physical people around to sign all those documents for courts, but we don't need 1,000 analysts, we can get away with 100 analysts, right? So think of this as, the scariest part is the profession that are most exposed are the completely mechanical coders. Let's face it, we pay millions, hundreds of millions of dollars. That's the first place. And I don't want to be mean, but I'm going to be mean anyway. But it's almost, one of my favorite German words is Schadenfreude. 30 years ago, remember these people just started advice to factory workers when they lost their jobs. What did we tell them to do? Learn to code. Most insulting thing I've ever heard. How does a 55-year-old steel worker in Ohio learn to code? You can't learn to code. Today, you know what's going to happen? Coders are going to lose their jobs. They learn to plumb. You're not going to have AI do your plumbing. Trust me, if there's a leak in your house, AI can't fix it. You need a plumber there. It's going to be a strange turning of what we thought of 30 years ago. It's coming for you this time. And I would say the same thing on a lot of financial analysis, which displaced those steel workers and told them learn to code. AI is now coming for you. And I don't.
So if you say that in the market, stock market today, 10 years from now, how many of the, what percentage of analysis of the stock market would be done by quantitative analysis?
We don't even need to go 10 years from now. Let's say passive versus active investing. Right? 50 years ago, 95% was mutual fund managed active investing. Last year, for the first time in market history, more money was invested in passive investing vehicles, ETFs and index funds, than in all of active investing put together. That's a threshold. This is not something that's coming. It's already happening.
Can I ask you something? Is that why then it could be creating a bubble in the market? Is it possible that the quantitative investing is not incorporating risk management?
Do you really think an active investor brought in that much insight? Active investors, 90% of them invest based on mean reversion. That was their entire investment philosophy, right? You want low PE stocks, why? Because you move towards the average. If I thought active investing brought deep stuff to the market, I would bemoan their loss and say, but I know what active investing brought to the market. My reaction is, guys, you're adding nothing of value here. So is passive investing feeding into momentum? Yes, in both directions. So far, we've seen the upward momentum, but the same force that caused it. So momentum is now a much stronger force in both directions because you've got Vanguard and BlackRock feeding into. So I think it basically, so active investing is not going to disappear. It just is going to become a much smaller business where you have to do something of substance to remain. And I hate to say this, but much of active investing doesn't add enough of substance, and that's the part that's going to disappear.
I'm curious, is there a world, Professor, where doing less means we're going to be free and more bored? And
this is what we see in the movies. We're always in luxury houses and robots and AIs. It never works that way, right?
That's right.
I mean, I'm old enough to remember when PCs first came out and we were told, think of all the drudgery that it's going to take off your hands. You don't have to sit there with a ledger sheet and a calculator. A PC will do it so much quicker. You see bankers with Excel spreadsheets? The drudgery has quadrupled. Then the internet came along and said, this is amazing. You can access all of the knowledge in the world from your home sitting on a computer. How did that work out? You get all the knowledge in the world and all the misknowledge of the world all thrown into a pile. You have no idea what's knowledge and what's fake and what's real. That didn't work out. Then social media came along. This is amazing. You can be friends with your long-lost cousin who lives in Vienna. Okay, that's nice. Friendship bound. What we've got is this toxic mix of social media, which is making depression levels go up, and my friend Jonathan Knight has talked about why smartphones have created this surge of depression, especially among 13, 14, 15. Every time technology has promised a better world with more amazing things, 10 years later you look back and say, that wasn't the case. I might be cynical, but 10 years from now, if AI takes off, is our world going to be, so much better? I don't think so. I think there's going to be a whole host of other stuff it brings with it that we're going to be dealing with. That technology will come up with something else to fix. But it's like a medication. You need a medication to fix the previous one, and each one you got to up the dose. So I'm not sure. Go ahead.
Dustin? How would you reconcile fostering or pushing for a process-based approach when you're working in a team that cares for results and say works backwards? I myself want to do some things of substance.
And I think in a sense that's part of the problem. We talk the talk, but we can't walk the walk, right? We said we want you to do the right thing, but then the minute you make a mistake, which you wouldn't do because it's not because you were not doing the right, you can do the right thing and still make a mistake. If I punish you for mistakes, for outcomes, rather than process, which unfortunately is the way much of the world works, over time you learn. You learn that process doesn't matter, outcomes matters, and you're going to do what gave you the incentive. So I can't fix that because it's coming from the top down. And unfortunately, it's that is the system you're working. You got to find another system where it's less driven by outcome and more by process. That might be not in New York. It might be in a very different environment. It might not be investment banking. It might not be trading. So I think there are some places where outcome is so critical that it drives everything else in the process.
I think we have room for one more, maybe, Professor?
Thank you, Professor. You've given us a lot to think about in terms of, I think everyone's thinking about how they're going to work in the world with AI and this way. Now, one thing is you kind of skipped over the very last slide, and I really would like to think what modes that you think you can erect, and maybe it's like, well, I didn't know.
I'll tell you, my mode is I have an idle mind. I dabble a lot. I know a little bit about a lot of things, and it gives me perspective. And I think I've seen this movie before, and I remember the last time I saw it. So it's not that I'm going to be caught up. I'm not. You see the charts of the Great Depression. You see it every time a market has a correction. Look, it looks exactly like 1929. That's a wrong lesson to learn from history. So you can learn from history, but you want to get too attached to it. So what I learned from history are these bigger lessons that hopefully I can carry through. So the most of the ones I listed, which is I have an idle mind. I have the time to just let things shuttle around. I can now one of the best decisions I made very early in my life is I wouldn't do a day of consulting, and I've stuck with that. And I've never been an expert witness, which is thank God for that. Which means I can say what's on my mind. So when my idle mind leads me to say Goldman screwed up, I say Goldman screwed up. What's the worst thing that happen? Somebody from Goldman as a student say, how can you say that about us? I wrote one of my harshest pieces about Evercore right after they did the valuation of Tesla, the Tesla Solar City deal. If you get a chance, go read the blog post. I said, this is the most incompetent discounted cash flow valuation I've ever seen. And I can't believe somebody paid you $8.5 million to turn up the scrap. It wasn't just mistakes, it was just, entirely breaking every single principle in valuation. So
that's why they paid the big bucks.
That's why they get paid the big bucks, I guess. But I think that in a sense, I have the luxury of just saying what's on my mind and not having to worry about consequences. And I know most people don't have that luxury. So I enjoy my freedom, but I'd like to think I work for it somewhat along the way by making choices that kept that freedom. And sometimes that means turning away stuff that can be really lucrative, saying, if I do that, then I'm going to have to abandon processes. The minute you become an expert witness, you can talk about processes as much as you want. But an expert witness for one side or the other, right? There is an outcome they want you for, and the lawyers will find a way to ask you questions. You don't have to explicitly lie, but implicitly you're undercutting everything you said is the right thing to do. And I don't want to be there because That's how you take the whole for kind of losing your first principles in the first place. Question back there. Now, did a question or no? Go ahead.
Do you have time? Do you have time?
I'd stay for another 20 minutes.
So, first of all, big fan, right? So, I want to push back on something, and I'm pushing back. That's my way of understanding.
No, I don't care about pushing back. I do ESG and sustainability stuff, do ESG and sustainability advocates, and I said terrible things. I describe ESG as an acronym: born in sanctimony, nurtured with hypocrisy, and sold with sophistry. That kind of captures what I think about ESG. I can't think of a good thing to say. Sustainability, I'm still working on the right insult to deliver. But it's a word that's taken over business schools. You got something to think about. If you believe in sustainability, I'll come back to your question. What are you sustaining? Are you sustaining the planet, which I agree we all care about? Are you sustaining products? Are you sustaining businesses? Make up your mind. You see, why can't I do all three? Because you have to choose. I use Gillette razors. What if Gillette could come up with a blade that never wears out? That's great for the planet, right? Think of how much this weighs. It's a sustainable product. But if you do that, what happens to your company? You're done. Imagine a printer where you never have to replace an ink cartridge. That's going to be catastrophic if you're a company that makes printers. But if you let sustainability be this thing that, it's good for all things. And the other thing with ESG and sustainability, I wasn't going to go there, but might as well go there, is the way it was sold was you can be good and you can be more valuable. You can be good and earn an alpha. And that, right from the beginning, that was the part that struck me as almost a fraud. And here's why. Through the history of humanity, has it been easier to be good or easier to be bad? Really? It's easier to be good? We don't need religion then. It's easier to be bad, so we have to create the structure of religion saying, don't look at your neighbor's house and try to steal it. Don't do this, because otherwise you'd be breaking into other people's houses and stealing stuff. The pathway of being bad is always easier than the pathway. So to be good, what do you have to do? You have to give up something. If you're Catholic for Lent, you're not to eat whatever you want for the next 40 days. Just give up something. The essence of goodness is sacrifice. And what does ESG say? You can be good, and you can earn a higher return. That cuts against everything that's ever been true in humanity. That is the lie that causes ESG and sustainability to fall on its face, right? Because the minute you sold it because you wanted people to invest because they could make a 50.5% more, not because they wanted to do good. You wanted companies to adopt ESG, not because it was the right thing to do for the planet, but because their value would go up. Now, I remember Larry Fink saying this in 2019, and my reaction was, he either is a useful idiot, and has no idea what he's talking about, or a feckless knave. Because there is no way you can tell me, and I live in the value space. It's got to show up somewhere, right? Cash flow, growth, the risk. So I'm sorry, I took away from that. Now I come to your question.
No problem. I think there's an incongruity with some of the stuff you said, which I'm trying to resolve. So kind of agree and understood kind of the points about, hey, subjective versus objective, which are kind of prone. I think the ultimate conclusion that a lot of these white-collar jobs may be prone to replacement with AI. I think my reaction to some of that is it's a misunderstanding of what some of those jobs are. So
let's make this specific. What's your job?
So I'm an investor.
Okay, so you're an investor. So you bring something. You're an active investor. You pick stocks. You work for a family office.
Private equity.
Private equity. Okay. So what is it that you do as private equity that you think adds value to the process?
So really, what I do, there's what I ostensibly do, but if you actually boil my job down, it's two things, right? So I make money for LPs, and
but that's the output, right? So tell me what allows you to make money for LPs. What is it that you do that allows you to make more money than that LP putting their money in an index fund? There must be something you bring to the table, right?
But that's what I'm saying. That's not my job. Is to make more than an index fund, right? My job.
Oh, wait. So I am putting my money with you. I'm paying you what's your fee structure?
2 and 20.
2 and 20. And you're telling me your job is not make more than an index fund? I'm not going to say that with a straight face. At least lie and tell me beat the market by 5 percentage points every year.
There are a lot of funds that have charged 2 and 20.
That's exactly why passive investing is winning. Is exactly that reason. You take 2 and 20 and you deliver what an index fund does or worse. You know that 90% of fund managers last year, and this is not based on any market. You go to SPVA, which is the S&P site where they look at the percent. 90% of active money managers have underperformed the market over the last 5 years. It's almost, if you think about it, it's a profession. It's the strangest profession, right? I mean, if you say, going back to plumbing as a profession, the analog I can think of in plumbing is you have to call yourself floods or us. And here's what you do. I have a leak in my house, you come and leave a flood, and then you send me a bill. You wouldn't last very long as a plumber, right? I know the analogy is getting stretched, but if you don't deliver more, at least believe you deliver more, the 2 and 20 is, one or the other has to shift. Either the money will leave you, or the 2 and 20 will go to 10 basis points.
So I guess that's kind of my point here in terms of where I'm trying to get at. So if you think about the Evercore example, right? Evercore received however many million in fees. They didn't receive fees for valuation, right? What they sold, the service they actually sold, was covered for the Tesla. Tesla and Solar City Force.
Let's say that your job as an investment banker is to get deals done that incumbent managers want done, even though it's not good for shareholders, right? That's what you're doing. Internally, there's all kinds of fiduciary. This is why you got to play the game and act like you're adding value, because if you did that, if you admitted that openly in a Delaware court, both you and the incumbent manager would be in trouble, right? So you got to dress it up. So what do? You invent those aspects.
Wait a minute.
Synergy and strategic considerations, because that allows you to pull this magic off. So I'm not disagreeing with why they did what they did, but if this is what your business model is to justify unjustifiable acquisition, and you're getting managers to be able to do it, it's not a sustainable model, right? The money will run out at some point in time.
So, So why do I get a QV from Grant Thornton, right? I want to believe the numbers are correct, but as much as I want to believe the numbers are correct, I also want to be able to tell my investors, look, if the numbers were wrong or they were fraudulent, it's not my fault, right? Grant Thornton has the QV. If I had an AI that was doing it,
I don't disagree with it. An entire business model built on people not wanting to take ownership of the decision, right?
So how does AI help with that issue, right?
Well,
it can never solve that issue, right?
Maybe McKinsey will use an AI consultant to do what this advice you are, and they would charge you a hefty amount for something you could have run internally, right? With an AI consultant. But then you can't blame somebody else. But I could start a McKinsey-like consulting firm with AI consultant that dish out this amazing looking advice that you can use as defense, but charge 1/10 what McKinsey does, right? So I think if your basic business model, you can't justify it. And I think a lot of basic business models, you can't justify it. There's no value add, there's value transfer, there's wealth transfer. You're standing on shaky ground. I mean, you're still on shaky ground for a long time, but think of how big that business is. I think AI or whatever else is going to come for you, it'll happen gradually. In active investing, it's happened already. But why can't that happen with consulting, with deal making? It's a question of time before it eventually plays out. And that's why I said you might be okay if you're 45 years old or 50 years old or 65. You really don't care. You'll outlast this process.
We'll take 7:26. We'll take one more question in the back there. Erica, at the end.
That's two questions.
Hi, it's great to see you. I sat in your class, so to speak, when I was a first-year analyst, way back at a large bank. So,
was this at one of the? I used to do the training programs in investment banks in August. Every single day, on any given day, I had no idea which investment bank I was in. After a while, started to put together. Go ahead.
So it's great to see you again. I mean, my takeaway from this is the one thing that AI can't replace is relationships. So it's a partner-to-partner relationship. There's an unknown between a senior partner at a private equity firm and an investor, right? So there's so many pieces that are inside of the analysis that goes in. Yes, you can replace the mechanics of the analysis, but that trust where you're not going to screw me, I'm not going to screw you, and we have an ongoing relationship for years to come. That's what's irreplaceable.
In fact, I gave this talk to wealth managers, across different banks. And if you think about wealth management, it's the most replicable of things in terms of mechanics, right? The wealth manager pulls out this life cycle that he's got and pulls out in the second drawer and says, you're 37 years old, you have to write 57%. He supplements it with something else he got from the parent company on these are the funds. But if you look at really good wealth managers, what they do is they know their clients, they understand their clients, they basically sometimes give up things that might be good for them as wealth managers because they want to build that trust. And if you look at the really good wealth managers, that's what they do. But then if you have your parent company that says you need to have more clients, you're not bringing in enough money, you're spending too much time with clients. In fact, what I'm arguing is the processes we see out there are actually undercutting exactly the things that make us, miss those client relationships that take time to build. And my worry is that and it's going to get worse, right? Your profits fall. What's the first thing you do? Have 15% more clients. You take time away from existing clients. I don't disagree with you. I think personal relations, that's what I mean by rediscovering your humanity, is the time you spend talking to people, even though it might not be productive time, might not be charging for them, might be a lot more valuable than what you call productive time, where you're churning out, plans for their next 10 years and what they should invest in. And I think we need to spend more time on those relationships. And those parts of the business, I think, will survive longer than the purely number-driven businesses.
But there's a dark side to it, though. I mean, if you look at it, you are essentially giving up the meritocracy, what you have learned and what you have become. And instead, you're going back to someone you went to school with, or someone you got married to, or someone from your own caste, or that'll be the darkest place to be.
Well, if it's all personal, then you're absolutely right. But why does it have to be either or? Why can't you take everything you've learned? You're not telling your client to do bad things. You take the things you've learned, you're helping your client, but you then have to adapt to the fact that your client might be much more risk averse, might be much more scared of crises than the typical person. You're taking what you've learned, trying to come up with solutions, creative solutions that are customized for your client because you understand what kind of person your client is, what his commitments are. So it doesn't have to be abandoning any of the stuff you've learned. It's taking the stuff you've learned and customizing it for people. If you're not customizing, then in a sense you're losing that.
I have a question.
Professor, I want to get your take on something because there's a pattern going on with when CEOs are making their presentations. And they start their presentation and they say pretty much our algorithm or logarithm or AI, one of the above, predicts our growth rate for this year at 3%. So just using a number. And my question to you is, what's your take on that? And then my follow-up would be, if I had to run up to the CEO, what questions would I ask?
I think that goes back to that story. I think the CEO's job and framing the narrative for the company. It's not the CEO's job to set earnings per share expectation. Let the people under you do that stuff. You got to frame a story for your company that is believable. And I call it the 3P test. Is it possible? Is it plausible? Is it probable? Let's take Starbucks, right? We know Starbucks is in trouble right now. Why is it in trouble? Because its story is broken. The Howard Schultz story for Starbucks was to bring the European cafe tradition to the US and spend money on expensive cafes in high-cost locations where people could get together and get customized drinks. I walked into a Milan coffee shop. They had a coffee shop and tried to order a venti cappuccino with soy milk and said, could you add a little whipped cream on top? He looked at me like I had two heads. You can get a cappuccino, you cannot get a cappuccino.
But that's the Starbucks. They basically created a version of a coffee tradition that was matched up to the American need for, I want something that's just for me. And it worked for a long time. And two things caused it to break. One is you saturated the market. There was a point in time where there were 6 Starbucks within 3 blocks of NYU. I could walk in any direction and hit them. They were eating up each other's profit. The other was COVID. What did COVID do? It created an online ordering system that more and more of us used. So I don't know about you, I haven't actually stood in line at a Starbucks to order my caramel macchiato in 3 years. So I ordered ahead. I go and guess what I see? There's this online desk with 20 people gathered around it, waiting for the online drink, and there are 2 forlorn people sitting in this expensive Starbucks location actually drinking coffee there. We have a business model that no longer gels. And of course, if you listen to the CEO of Starbucks and they say we can grow 10%, the question I would have is how? How are you going to grow 10%? What is your new storyline that you're going to be able to do? What is it going to cost you? Maybe your new storyline is you're going to replace these expensive locations with cubicles. Why do you need these expensive? Well, you just pick up your coffee, right? You have, all baristas lined up. They just put the coffee out of there on the. But that's going to cost you money. Have you thought through what that would cost you? Those are the questions I think we need to ask CEOs. It's not just, I change the company. That doesn't mean nothing. Change the company by doing what? What exactly are you going to do? How much is it going to cost? How will it get people back into those stores? And I use Starbucks as an example. You can take Intel, another broken story, right? A company that wanted to be like a wannabe company, is what I called Intel when I wrote about last year. They wanted to be like Taiwan Semiconductors, so they started the foundry business. They wanted to be like NVIDIA, so they spent billions on it. But the problem is they were neither. They ended up almost driving themselves into the ditch. So at this stage, when I listen to the CEO of Intel, I don't want big stories about we're going to be the greatest semiconductor chip company. It's not happening. Be like Yahoo in 2013 with Marissa Mayer saying, we're going to become the dog. In what universe is that even feasible? So when you see managers overreaching, CEOs overreaching, it's your job and my job. And this is one of my problems with earnings reports is the focus on the per share number, and we get lost in the details, and nobody's asking questions about, hey, what does that report tell me about the story for the company? So tomorrow when you watch the NVIDIA report, don't get distracted by those numbers that we get the most attention. What are the earnings per share? What are the revenue? Those are all interesting numbers. The question we're asking is about storyline. Their story is built on companies continuing to spend huge amounts of money on NVIDIA chips because we've sold the story that you cannot build an AI system with regular chips. You need these superpower chips. And I wrote about DeepSeek. I said that, in a sense, opens the door to that story potentially being false, right? So tomorrow, Jeff Swang's going to be on CNBC. I hope Scott asked him that question, which is, how did DeepSeek change the way you think about this market? He said, not at all. That's not a good answer. It has, at least it should lead to some introspection about, what does this mean for my future as a business? The story I'm telling is an AI.
Thank you. That leaves you with the 45 minutes.